Once upon a time, what Wall Street calls shareholder value was considered manipulation. If a company spent its own money to inflate its stock price, that wasn't financial genius, it was fraud. Executives could be arrested, companies fined, reputations ruined. Today, it's the opposite. Stock buybacks, the act of a company repurchasing its own shares to boost their price, have become the single most powerful engine of corporate America. They lift markets, inflate CEO bonuses, and quietly transfer trillions of dollars to shareholders without creating a single new product or job. So, how did something that was once a crime become the backbone of modern capitalism? Welcome to The Financial Historian, where money, power, and history collide, and nothing is ever as simple as it looks. The story of stock buybacks begins with a collapse. In the roaring 1920s, markets were treated like casinos. Executives manipulated their own stock prices, bankers floated insider deals, and fortunes rose and fell overnight. The New York Stock Exchange was a theater of illusion, and everyone wanted a starring role. When the crash came in 1929, the tricks that fueled the boom turned deadly. Corporations had been using their own cash reserves to buy shares and prop up prices, giving investors a false sense of security. As panic spread, those same companies were forced to sell off shares to survive, accelerating the collapse. By 1933, confidence in capitalism was broken. Factories closed, banks failed, unemployment hit 25%. The public no longer trusted Wall Street or the idea of a free market. In response, President Franklin D. Roosevelt's administration did something radical. It rewrote the rules of capitalism. The Securities Exchange Act of 1934 created the SEC and made one thing very clear. Companies manipulating their own stock prices would no longer be tolerated. The logic was simple. The market was supposed to reflect value, not vanity. For the next 50 years, stock buybacks were essentially illegal, not by name, but by definition. If a company bought its own shares to influence the price, it could be prosecuted for market manipulation. And so, for half a century, the American economy grew without this trick. Corporations reinvested profits in research, factories, and workers. CEOs were builders, not traders. The stock market was a measure of industrial power, not accounting precision. The system wasn't perfect, but it was productive. Until one idea changed everything. In 1970, a quiet revolution began. Not in the factories, but in the universities. Economists like Milton Friedman began arguing that the only responsibility of business was to increase shareholder value. To many corporate leaders, this was liberation. They had spent decades being judged on stability and employment. Now they could focus on what really mattered, the stock price. By the 1980s, that philosophy met its perfect political moment. Ronald Reagan came to power promising deregulation, smaller government, and faith in the market. Wall Street was ascendant. Investors wanted higher returns. CEOs wanted flexibility, and corporate America wanted a way to push stock prices higher without waiting for the slow grind of real growth. They didn't want to change what they built. They wanted to change what it looked like. Enter 1982. While few were paying attention, the U.S. Securities and Exchange Commission quietly passed Rule 10b-18, a single-page regulation that would reshape capitalism for the next 40 years. The rule created a so-called safe harbor. It allowed companies to buy back their own shares without being accused of market manipulation, so long as they stayed within loose daily limits. No congressional debate, no public hearings, just a subtle rule change in the middle of the Reagan Revolution. In one stroke, the SEC had legalized what generations of regulators had banned, the right for corporations to manipulate their own stock prices, as long as they called it returning value to shareholders. The results were immediate and seismic. Before 1982, companies rarely bought back their own stock. They paid dividends, invested in research, expanded production. After 1982, buybacks exploded. At first, it was a trickle, a few $billion a year. Then it became an addiction. By the 1990s, buybacks exceeded $100 billion annually. By the 2000s, they were normal corporate behavior. And by the 2010s, they reached astronomical levels, over $1 trillion a year. The logic was elegant and devastatingly simple. When a company buys back its own shares, the number of shares in circulation drops. Fewer shares mean higher earnings per share. Even if total profits stay the same, on paper, the company looks more profitable. Stock prices rise. Executives' bonuses, tied to those prices, soar. No new products, no new jobs, just math. This wasn't capitalism in motion. It was accounting as alchemy. Buybacks became the corporate equivalent of plastic surgery, a way to look younger and more valuable without actually changing what's inside. And Wall Street loved it. The 1990s turned the trick into an art form. Tech companies, flush with stock option-based compensation, began buying back shares to offset dilution from those same bonuses, effectively using shareholder money to inflate their own paychecks. Then came 2008. After the financial crisis, when taxpayers bailed out the banks, those same institutions spent the next decade using profits, and often borrowed money, to buy back their own stock. Between 2009 and 2019, the top 500 U.S. companies spent over $6 trillion on buybacks. That's more than they spent on all new capital investment combined. Buybacks don't build resilience. They build illusions. They make markets look healthy until they aren't. They make companies look rich until reality catches up. And yet, even as critics called for reform, Wall Street defended them as efficient. Because in a system that worships the stock price, nothing matters more than appearances. By the time buybacks became routine, the very definition of success in corporate America had changed. Growth no longer meant new factories, new products, or new ideas. It meant fewer shares and higher charts. The economy had turned inward, companies feeding on themselves, investors chasing reflections of wealth rather than the real thing. And it wasn't just corporations that adapted to this illusion. Governments did too. Rising stock prices became political proof of stability. Presidents and prime ministers pointed to the markets as evidence that everything was fine. Central banks watched them like vital signs. In the new order, as long as the stock market stayed high, no one dared to say the patient was sick. But that's the problem with illusions. They only last as long as people believe in them. When buybacks first surged in the 1980s, their defenders said it was efficient capital allocation. If a company had extra cash, why not return it to shareholders instead of wasting it? On paper, it made sense. In practice, it hollowed out the system. By funneling cash to shareholders and executives, companies stopped investing in long-term resilience. Research and development slowed. Wages stagnated. Productivity flatlined. Meanwhile, executives grew richer than ever, not because they led better, but because the rules let them buy higher bonuses. Their compensation packages were tied to stock prices, and buybacks were the easiest way to push those prices up. That's the hidden genius of legalized manipulation. It doesn't break the system. It becomes the system. By 2018, U.S. corporations were spending more on buybacks than on capital investment. Apple, Microsoft, and ExxonMobil alone accounted for over 20% of total corporate repurchases. Entire industries turned into stock management machines. Airlines, retailers, even tech giants that once symbolized innovation were now primarily financial entities. Their main product wasn't hardware or services, but shareholder returns. The 2008 crisis should have ended it. When the economy collapsed, it was clear how fragile the system had become. But instead of reform, bailouts restored the illusion. Central banks flooded the markets with cheap money. Debt became nearly free. Companies borrowed to buy their own stock, creating the biggest wealth transfer in modern history. Between 2010 and 2020, U.S. corporations spent over $7 trillion on buybacks. That's the GDP of Japan. The top 1%, who own more than half of all equities, captured almost all of it. Workers got unemployment. Executives got record bonuses. And just like that, the cycle repeated, only bigger. By the time the pandemic hit, companies were more leveraged than ever. And when revenues vanished, the same corporations that had spent years inflating their own shares lined up for public bailouts. The money that could have built resilience was gone, converted into stock price highs and quarterly bonuses. The illusion was complete. Profit had replaced value, and survival had become the next quarter's problem. Buybacks weren't just a financial tool anymore. They were an ideology, a symbol of a system that rewards extraction over creation, efficiency over endurance. The effect on inequality was staggering. Every repurchase enriched those who already owned shares. The wealthiest 10% of Americans, who now hold nearly 90% of all stock market wealth. For everyone else, wage growth lagged behind inflation, while savings eroded under rising costs. The ladder to prosperity was still there. But now, the rungs were missing. And as this imbalance grew, markets became addicted to buybacks. They weren't just an outcome of prosperity, they were its illusion. Without them, stocks fell. So companies borrowed even more to keep them going. Between 2010 and 2020, corporate debt doubled. Balance sheets ballooned. Profits looked endless, because the system had learned to recycle money faster than it could create it. What used to be manipulation was now monetary policy. Because when the market crashes, it isn't just investors who panic. It's governments. The same institutions that once outlawed manipulation now depend on it to maintain confidence. High stock prices calm the public, fuel pensions, and make leaders look competent. And so the illusion keeps growing. Quietly, beautifully, dangerously. If you think this sounds familiar, it should. The 1920s ran on the same fuel. Cheap money, inflated stocks, and faith in endless growth. And just like then, the warning signs are all around. When a system values appearances over productivity, when it rewards the few for inflating numbers the many depend on, when capital stops circulating and starts concentrating, collapse is only a matter of timing. Buybacks were supposed to be a sign of strength, proof that companies believed in themselves. Instead, they became proof that they no longer needed to. Why invest in the future when you can buy the past and call it profit? This is the ultimate irony. The same mechanism that once destroyed markets is now celebrated for sustaining them. What used to be manipulation is now called efficiency. What used to be illegal is now the core engine of growth. And history tells us exactly where that path leads. Because the deeper you study buybacks, the more they resemble every financial bubble before them, an economy addicted to its own reflection. The more we rely on rising prices for stability, the more fragile that stability becomes. It's not real growth, it's gravity delayed. And when the cycle breaks, when confidence finally collapses under its own weight, the damage will look eerily familiar. Not a crash of innovation, but a crash of trust. The kind that doesn't just bankrupt investors, but faith in the system itself. Buybacks are not just a story about corporate greed. They're a story about how power rewrites rules. In 1934, manipulation was outlawed because it destroyed markets. In 1982, it was legalized because it made them look good. That's not progress. It's regression disguised as sophistication. The most expensive illusion in history isn't a bubble. It's belief. Belief that you can keep printing confidence forever, and that numbers on a screen can replace the fundamentals that built the system in the first place. The next reckoning won't come from a crash, but from realization. The moment people stop mistaking inflated prices for prosperity. Because when that belief breaks, every illusion it supported will collapse with it. Stock buybacks were made legal to make markets efficient. But efficiency without purpose is just decay, accelerated. The system that once criminalized manipulation now depends on it. And the result isn't capitalism, it's choreography, a dance designed to make decline look like success. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.